Do not let the silence deceive you. Right now, the markets are closed. The screens are dark. The ticker tape is frozen. Silver is locked at $71.47. It feels calm. It feels like the world has paused for the new year. But this is not peace. This is pressure. We are sitting in the eye of the storm. Tonight, at 6 p.m. Eastern, the electronic futures market reopens. And when that switch flips, 2 weeks of trapped capital will be released all at once. This is not the start of a normal trading session. This is the opening act of a new trading year. And in institutional finance, the first week of January is the most aggressive, most violent, and most profitable week of the entire calendar. They call it the January effect. This isn't psychology. It's mechanical. Pension funds, insurance pools, sovereign mandates, hedge fund models. Hundreds of billions of dollars are forced to rebalance at the start of the year. And this year, the models have a problem. Their algorithms are programmed to chase performance, to rotate into the asset that worked last year. In 2025, bonds failed. Stocks were unstable. Real estate stalled. Only one asset consistently outperformed: silver. Now here's the problem. They're mandated to buy it, but there is no silver to buy. The vaults are drained. Dealers are sold out. Miners are hoarding production. So when this institutional wave hits tonight and tomorrow, it doesn't hit a liquid market. It hits a wall of scarcity. That is how squeezes are born. In this investigation, we are preparing you for the opening bell of 2026. We're going to break down the mechanics of the pension fund panic. We'll explain why the same banks that smashed silver into year-end are about to reverse and chase it higher. And we'll lay out the tactical roadmap for the next 48 hours, because the countdown has already started. To understand why this moment matters, you need to understand how Wall Street actually functions. Retail investors trade on emotion. They buy excitement. They sell fear. Institutions trade on dates. December 31st is everything. Up until midnight, the market was defensive. Funds sold winners to lock in bonuses. Banks dumped assets to reduce regulatory risk scores. Taxpayers sold losers to harvest write-offs. December is pure selling pressure. But the second the calendar rolled to January 1st, the game flipped. Defense ended. Offense began. New allocations activated. Every major fund starts the year underweight commodities. They want 2% here, 5% there, and right now they own 0. So they have to go from 0 to fully allocated, fast. Historically, this buying is compressed into the first 5 trading days of January. It creates a tsunami of demand that has nothing to do with news and everything to do with mandates. And this year, the tsunami is larger than ever. Why? Because silver was the best performing asset of 2025. The computers aren't debating. They aren't emotional. They are screaming one word: buy. Let's put numbers on it. Global pensions and endowments control roughly $50 trillion. If they shift just 0.1% into silver, that's $50 billion in demand. Now look at supply. The entire planet produces about 800 million ounces per year. At $71, that's roughly $56 billion total. Do you see the problem? The funds want to buy nearly the entire annual supply in 1 week. It doesn't fit. So the price must rise, not because of speculation, but because price is the rationing mechanism. This isn't theory. It's physics. Tonight, the water starts pouring. The first crack in the dam doesn't come during regular trading hours. It comes tonight. At 6 o'clock p.m. New York time, the Globex electronic market reopens. This is where the algorithms trade while the human traders are still at home. Holiday sessions are usually quiet, but this one won't be. Why? Because while New York was closed, Asia never stopped trading. Shanghai stayed open. The physical markets stayed active. And the price gap never closed. Silver in the East is still trading at a premium to the West. That gap is oxygen for arbitrage algorithms. The moment Globex opens, the machines will wake up, scan the global price feeds, and see the same thing. Silver is cheaper in New York than it is in China. And when algorithms see free money, they don't hesitate. They buy first. They buy fast. They buy without emotion. That's how we get a gap up. If silver jumps from $71.47 to $73 in the opening minute, that's not noise. That's a signal. It tells every human trader watching that the dip is over, that the selling is exhausted, that the window closed while they were waiting. And once humans realize they missed the bottom, the second wave begins. FOMO. Fear doesn't push markets higher. Urgency does. Now, let's talk about the banks, because this is where the narrative flips. Last week, the banks were sellers. They had to be. The year-end G-SIB risk snapshot forced them to dump exposure. They smashed the price into New Year's Eve, drove silver down to the low $70s, cleaned up their balance sheets, lowered their risk scores, and locked in their bonuses. Mission accomplished. But that snapshot is over. The regulators took the photo and left the room. Now the banks are free. And banks don't trade to protect the system. They trade to front-run it. They know what's coming. JP Morgan knows pension funds are mandated buyers this week. Goldman knows commodity allocations reset in January. Every major dealer knows forced flows are about to hit the tape. So they don't stay short. They flip. They buy before their clients buy. They buy tonight at $72. So they can sell tomorrow at $75. This is how Wall Street really works. The suppressor becomes the squeezer, temporarily, because riding the wave up is more profitable than fighting it. So now look at the alignment. Asia is buying. Pension funds are buying. Algorithms are buying. Who's selling? No one. Miners are holding back supply. Dealers are already empty. Retail investors who survived the smash aren't letting go. This is the exact setup required for a vertical move. And while the paper market has been asleep, the physical market never rested. Factories in China are still consuming metal. Mines in Mexico are still depleting. Solar and EV supply chains are still pulling ounces out of circulation. So before the open, we check one thing: dealer premiums. And they're screaming. Silver Eagles are now approaching $20 over spot. That's not normal. That's not seasonal. That's scarcity. When the paper price drops but the physical price rises, the message is clear. The paper market is lying. Spot says silver is abundant. Premiums say silver is extinct. This divergence never resolves downward. It resolves violently upward when paper snaps to reality. Now add one more accelerant. January isn't just allocation season for funds. It's procurement season for industry. This is when companies like Samsung, Tesla, and First Solar lock in supply for the year. And this year, refiners are telling them the truth. We can't deliver what you need. So what do industrial buyers do when supply is threatened? They panic. They pay any price to keep factories running. $75? Fine. $80? Fine. Private deals are already clearing above screen prices, quietly, off exchange. Every one of those deals remove metal from visible inventories. So when traders check warehouse reports this week and ask, where did the silver go? The answer is simple. It left the system, and it's not coming back.